All right, welcome to the Multifamily Investor Nation webinar for this week. Today, we're going to be talking about the transition from Libor, the London interbank offered rate, and then the SOFR. And SOFR, it means secured overnight financing rate, and what it means for you in apartment syndication. And today's webinar is going to be a little bit shorter because I really just want to talk about the high-level specifics of this. I don't really want to get into a lot of the different, nitty-gritty weeds of these different types of rates, because for multifamily, it's a very limited impact on our assets, if you will, or on our financing. But before we get started, I wanted to touch base with you regarding a couple of things. So first off, my name is Dan Handford. I'm one of the managing partners with a group called PassiveInvesting.com, and our group has acquired over 220 million. Actually, as of tomorrow, we're closing on another $50 million property tomorrow. And so as of tomorrow, that number will go up, right? It's going to go up to, almost 207, now at 270 million in acquisitions. And we have over 400 investors and have acquired over 2,000. This is 1984, but we're closing on another 232. And this actually should be already at 2006. I'm not really sure why it says 1984, but we're over 2,000 units. And so if you're interested in joining us on one of our future opportunities, would love to have you do that. You can go and find more information about myself here on the Meet the Team page, and you can find out all the information about our group. And then you can also, on the top right-hand corner, go to Join Passive Investing Club. And when you click on that button, there'll be a form like this that'll come up. You fill that form out, I'll jump on a phone call with you, and we'll have a discussion as to what your investment goals are to see if our group is the right fit for you. So the next thing I wanted to mention is this Mfin Summit that's coming up. Just want to mention this briefly. You can go to the website on the screen here. It says it's just Mfin, stands for Multifamily Investor Nation. So mfinsummit.com. It's a live, online, all virtual 3-day event. And it's right now scheduled for June 11th, 12th, and 13th. So you can go to mfinsummit.com and find out more information about the summit that's coming up. And I would also encourage you, if you are after the summit, you're watching this recording, maybe you're watching it, say, in July or August, we will have another one of these scheduled in January of 2021 and ongoing. So go to that page, you'll find the updated dates and the updated list of speakers and things like that. And so you can go there and register for this event. If you're a registered paid attendee, even if you can't attend all 3 days, or you only want to watch maybe say half of the sessions, we're going to record all of the sessions. And as a paid attendee, you'll get access to all of those session recordings included with your ticket. All right, so let's go ahead and dive into the topic for today. The topic for today is going to be about this Libor and transitioning to SOFR. So let's just dive right into this. So as most of you know, I don't use a lot of PowerPoints, but I do have a Word document today that I'm going to share with you that will help guide you in the discussions that we're going to have today. And so we're going to talk about what is Libor, and that's how you say it, Libor, and then what is SOFR, SOFR, and then Libor is just Libor, Libor. And then we're going to talk about how this impacts multifamily, and then we're going to talk about what you should be looking for in your loan documents to determine which one of these your lender is using, and maybe even just what they're using now and what will they potentially be using into the future when we start transitioning away from Libor and going more into the SOFR route. So I mentioned it earlier just a little bit. Excuse me, got a little hiccup there. Just a little bit. Let me grab some water real quick here. So one of the things that we mentioned earlier was what these different acronyms mean. What do they stand for? And so one of the things that I wanted to mention to you is Libor stands for the London interbank offered rate. Okay. And then SOFR stands for secured overnight financing rate. And I want to share my screen here with you. That's a little bit different than what you're seeing now, because I want you to be able to see how to spell this information, we're going to also go over the differences between the two. Okay. So give me just a moment here. I'm going to share a different screen with you, this Word document. All right, this is just something I threw together for you to make it easier for you to kind of follow this, because I know with these types of terms and things like that, it can be a little more challenging. But this is how you spell LIBOR. So just London Interbank Offered Rate, and then SOFR is the Secured Overnight Financing Rate. The LIBOR is something that has been like the standard for determining kind of like a rate, if you will, for setting rates plus spreads on rates, if you will, for interest rates. Primarily for primarily for floating rates, if you will. It's like short-term debt, right? So if you're getting a bridge loan in multifamily, they'll usually use LIBOR plus a spread on top of that, which is called the credit risk spread, which we're going to talk about here in just a minute. And then that's one of the main differences between LIBOR and SOFR, is that LIBOR, it actually includes credit risk, means that there's actually credit risk involved with it. And with SOFR, there is no credit risk. And so we're going to start seeing some things to be different into the future in regards to where these kind of interest rates might actually come in regards to this, because there's going to be some spreads and, credit risk they'll include with that or on top of it. And this is going to be probably a webinar where, if you're not familiar with multifamily financing, this might be a little bit over your head, and that's okay. But just bear with me and kind of stick with me through it, because it'll help you start to understand and put some of the pieces together about how a lot of this stuff works. So the LIBOR has been it has been the rate that has been around the longest. And it's something that is forward-looking, if you will. And you can see that here on the screen. Let me see if I can get my my little clear button to show up here. There you go. So there's my little red button here. So to make sure everybody is paying attention and hearing me okay, do you guys see this red dot on your screen here that they call it the spotlight button? So if you do, just type into the chat box, but just raise your hand on the screen there. Just raise your hand and let me know that you can actually see that. Good, awesome. So got a lot of people that are watching this, paying attention. Have over 100 people today on this webinar, and excited to be sharing with you this information. So you can see here on the screen, this is the LIBOR column, and this is the SOFR column. What I would suggest you do here is get out your phone and just take a quick picture of this, so you can kind of get this into your files, into your records for looking at it and reviewing it even after the webinar. Take a picture of it with your phone, or do a screenshot if you're on your computer, whatever you need to do to be able to save this. And this LIBOR, as you can see here, is forward-looking, right? So it actually gets rates from banks all across the country or across the world, and actually determines what that future potential rate is going to be. And then the overnight rate is backward-looking, so it actually is looking into the past and actually the current rates that are happening right now. LIBOR itself is actually unsecured, so there's no it's not securitized by anything, but the SOFR is actually secured with treasuries. Okay, and so and the reason why that's important is because it actually should help to stabilize some of these rates, because there's no credit risk when it comes to these risks, because this is a rate of what has already happened in the past, and also up until the night before. And so these banks report this information, and it becomes available, and so there's no credit risk. The other thing that's interesting about this is the term structure. So there's actually going to be a term structure that you will see with LIBOR, which will again include an additional rate on top of yours. That's called the credit risk rate. And then with SOFR, there's not going to be really any term structure with it. Okay. So it's going to be interesting to kind of see how this happens, because the transition right now has been happening for the last probably 1 to 2, possibly 3 years they've been working on this. And the goal for transitioning from LIBOR and really away from LIBOR and going to SOFR is planned originally for the end of 2021, but it's likely not going to be done until probably 2022. And the reason why that's important is because obviously we're talking about how does it impact multifamily. And the biggest impact for multifamily, I think, is going to be we're going to start to see either some tightening of these interest rates, so they're not going to be kind of all over the place. So that'll be really good. And of course, the last question we have on here is about kind of looking at the loan documents, right? And kind of figuring out how do we determine which one our lender is going to use. The problem with the transition is that if you just all of a sudden stop using LIBOR and just go to SOFR, then you're going to have some sort of differences in rates, and it's going to be kind of hard to determine this. And for those of you who have a floating rate loan, this could potentially be really, really good for you, or really, really, really bad for you, because it's going to depend on how these rates actually are closely aligned with or not aligned with the LIBOR rates, because a lot of these loans that you get are based off of the LIBOR floating rate. And so as LIBOR floats over time, your interest rate also floats. And so it's going to happen the same thing with the SOFR, but that rate's going to be different, right? And so we don't really know what that's going to look like yet. So there's still a lot of things that are happening in the back end, in the background, to try to determine a lot of this. But what's important in your loan documents to really kind of pay attention to is which one they're going to be using and how they are going to actually transition. Because in the loan documents, if it just says LIBOR, well, I mean, what if LIBOR goes away? What are they going to use? And so a lot of times, if you look at your loan documents, it'll say LIBOR or other similar exchange rate, or offer, or interest rate, assumptions or whatever. They'll have some sort of special language in there that will allow you that will allow them some flexibility. But you want to make sure that you have reviewed those loan documents if you are getting a floating rate. Obviously, fixed rate debt is really nice, because you don't have to really worry about either one of these things when you have fixed rate long-term financing, because they're usually going off of the 10-year treasury and some spread off the 10-year treasury, right? And so it's a little bit different than these types of short-term debt. And that's really what LIBOR and SOFR are for, is for really short-term debt, if you will. A couple of really nice things about this as well is that the LIBOR is really based off of what we call bank submissions and expert judgment. And so there's a group that actually receives the reporting for this from the various banks, and they use their reporting system and their best judgment to determine. There's literally like 7 different rates that they'll come up with that are 24-hour rates, like 10-day rates, 30-day, 3-month, 9-month, 12-month rates when it comes to LIBOR. And with SOFR, it has actually not using anybody's expert judgment or submissions from banks from that. It's actually transaction based, and so the volume of transactions that are happening every day that set this rate are at roughly $1 trillion, which is what you see right here. And with the LIBOR, it's based on roughly about 1 billion in transactions per day, because not all of the banks actually submit and report. And actually, since the 08 financial crisis, there's actually been fewer banks that have actually continued to report to affect the LIBOR curve. And so it's a little bit of a kind of high level discussion around this transition from LIBOR to SOFR. But the biggest thing here is as you guys are looking at debt and they're basing things off of the LIBOR, you need to be having the discussions with your lenders about what are you going to be using when the LIBOR goes away in the next probably 12 to 24 months. What happens when it goes away? What are you going to be using? Are you going to be using SOFR? Are you going to be using something different, or are we going to maybe set a rate based on X, Y, and Z? You got to have that conversation with them, and most likely these banks are going to have some sort of solution or answer to that by the time you're raising the question, because you won't be the first one to bring that up. So you need to make sure that you have that. So I want to open it up now and answer any questions that you might have. I told you this one was going to be a little bit shorter than normal, just because I wanted to keep it very high level when it comes to this topic, because there are a lot of different nuances when it comes to this topic between the LIBOR and the SOFR, and kind of transitioning from one to the other. So do you have any questions in regards to this? I'm going to go ahead and open it up to the audience here, and you can use the chat box there. If you want to use the Q&A box, you can do that as well. And I figured there probably wouldn't be very many questions, because this is one of those things where it's a little bit confusing, if you will, for some. And I do have one question coming in here from Scott. Do you feel the rates will be higher? I don't really know how to answer that, Scott, because we don't really know. I honestly think that they will be fairly close to where they were before, but maybe even a little bit lower is kind of my assumption to this, right? And Bill has a question here about, have any of the large lenders like Arbor said anything about this? Yeah, so they are talking about this. They are having discussions about this. And if you look at some of your loan documents now, they'll actually start to talk about the SOFR and how right now they're using the Libor curve, forward curve, and then they're going to be transitioning to that. And when they do transition, your debt will, your interest will change based on that transition. What are the potential benefits to us as investors because of this? This is Nicholas asking this question. So Nick's question here is about the potential benefits, or maybe the opposite, the potential downside, if you will, for investors because of this change. And I think that it could go both ways. So it could either be higher or lower depending on the outcome of this, right? And where the various lender, and I think these lender. I mean, I have somebody else bringing in here about Andrew's asking, what are the options to appeal the new bank imposed rate structure if you feel it's unfair? I don't think most loan documents address this. It is going to be a bit of a challenge. So, I don't think that lenders are going to try to get to a point where they want to just have a bunch of, fighting back and forth with their borrowers, especially ones that work with them all the time. They're not going to want to have this, back and forth, if you will, with their borrowers. I mean, they're going to have I think they're going to be smart about it. I think they're going to have a solution for us available when it comes about. And if it is crazy higher or even crazy lower on both ends, there's going to be something in there to be able to mitigate this type of risk. And one other thing to mention is I mentioned it earlier, but Tony's bringing it up again, is that these types of rates, this Libor and SOFR, is for short-term debt or bridge debt. So this is or variable rate. So it might be a long-term debt, but it's variable. It's a variable rate. So they use the short-term rates for this. And so if you're in a fixed-term rate or anything like that that's not moving, this doesn't really have any benefit or bearing on you at all. And it's and most of those fixed rates aren't based off of SOFR or Libor. They're usually based off of the 10-year treasury and some spread on top of the 10-year treasury. Let's see. I know you said this is for short-term debt versus fixed debt. For multifamily, what would this impact? Bridge loans, what other types of debt? Yes, so it could impact the bridge. It will impact the bridge loans, and it could also impact even just private lenders. I know even Fannie Mae and Freddie Mac have what is called variable term or variable interest rate loans, where you can get them for 5, 7, 10, 12 years terms, and it is variable rate. So anything that is variable rate in the term is usually basing their rates off of Libor and will eventually move over to SOFR. Will this affect agency or bank or commercial bank loans? The answer is it depends. So it depends on if it's going to be a variable rate or not, but it will affect both if you're looking at a variable rate loan on here. Let's see. Is there an example from the SOFR committee for a given risk? How does it compare? I don't think they actually have that right now and available. So I don't know the best way to answer that question for you, Kumar. But once they get a little bit closer on this thing, I think there will be some additional examples about how they're actually going to be able to compare the two. But remember that the SOFR is a risk-free rate. So there is no credit risk in there. When you're getting term sheets, the lenders are building into it their credit risk, if you will, on those rates potentially changing. So I think what you might actually see, because you're not having to pay for that credit risk, one of the impacts could be is that we actually have better interest rates because that credit risk is actually not there. And so you might actually see a little bit better interest rate. Let's see. Do you think that we'll see negative interest rate loans in the U.S.? I think it's likely or possible, but I don't think that we will. If I was to put a speculation on it or not, I think that the Federal Reserve has been monitoring this very closely and is doing their best not to get to that level. But I know President Trump has encouraged to try to get to that level. So I don't know if we will or not. I think it's definitely possible. It's not outside of the realm of reason, or possibility. But I don't think that we're going to actually see that, at least not anytime soon. Let's see. Based on your vast experience in this area, will you trust the lending institutions to fully understand the new changes, or should we all be super knowledgeable ourselves? No, I fully believe that these lending institutions will take these new this new SOFR and fully understand it. And actually, oddly enough, the person who brought this to my attention was somebody works for one of these large institutions and saying, hey, this is coming up. You need to be aware of this. This wasn't just recently. This has been probably a year and a half, 2 years ago. This was brought to my attention. And I just thought it'd be really good to do a webinar on this topic to be able to, put it on your radar right now as well. Could also affect a fixed rate loan if we're under contract but haven't rate locked yet, right? No, not usually, Greg, because usually if it's a fixed rate loan, they're going to be using the 10-year treasury as your kind of base rate, and then you're going to have a spread on top of that 10-year treasury. And right now, because the 10-year treasury has been so low, a lot of times in those fixed rate loans, they'll set a floor or a bottom or how low that rate would go for the 10-year treasury. And then there'll be some sort of spread or extra interest amount above the 10-year treasury rate that we're seeing right now. Could you explain LIBOR having term structure versus SOFR having no term structure? So John is asking, could you explain LIBOR having term structure versus SOFR having no term structure? From what I've read on this, John, basically, they're not going to have, because there's no credit risk in here, they're not having to base a lot of additional interest on top of that. So there won't be as much additional on top of that rate, if you will, I think. Again, I could be getting it completely off or completely wrong, but that's just what I've read in my research, is that because of the lack of credit risk in SOFR, there's not going to be a term structure that's built into it. Let's see. What is the main motivation for this change if LIBOR is working okay? Are there complaints from customers that forces this move? So that a lot of these banks have been not reporting, and the LIBOR is based off of banks actually reporting their rates, and so that they can actually determine this, right? And so this is going to be a more accurate way to be able to look at this. And it's not based off of banks reporting. It's actually based off of transactional data, which is automatically determined, actually put in. So that's going to be, that's the main motivation from it is fewer and fewer banks have been reporting to LIBOR. And so there's a lot more credit risk, I guess, if you would say, in it, because they don't really know for sure how accurate those numbers are. So even though it has been working okay, because we have had more transaction volume, going to a more transaction-based number is what most people are trying to go towards. Any recommended readings on this subject? So there is actually an article that I pulled up earlier that was on this particular topic. That so LIBOR, the forward future LIBOR curve is usually talking about it's usually with the Pensford forward curves. Okay, so if you type into Google and you type in the Pensford LIBOR curve, you will see that. But then you can also type in Pensford and just say LIBOR versus SOFR, and you will find an article in there. I'll just see if I can type it into the chat box here for you. So here is, let me resume sharing here. Here's the actual article here. I'm going to type this link into the chat box for you guys, so you can go ahead and click on this link if you like to kind of continue to read up on this transition from LIBOR. And it gets into a lot of it. This is a really heavy, intense article. And that's actually where I pulled this chart and graph from, is from this website. But they have they have the timeline data here and all of the different kind of nuts and bolts. If you're curious about a lot of the details in regards to this and some of the reasons behind it, this would be a great one to kind of review and go through. So you can certainly go to that website and find more information and read up on this. Well, that's all the questions I have for today. I know there's been a few other ones that were in here, but I promise you I'd try to wrap it up around 12:30 Eastern. And so I want to thank each one of you for being here today and participating with the webinar. Before you jump off, make sure you go to mfinsummit.com and register for the next webinar that's coming up less than a month away now in June. So go do that now, and looking forward to having you at the event. It looks like I got Bill on here, said I already got my ticket. So good. Awesome. So looking forward to having you there, Bill, and looking forward to seeing each one of you that are on here at the webinar as well. Let me actually see if I can refresh my screen here. Oh, there we go. So here is our next event for next week is going to be asset management for multifamily assets. So we're going to be talking about what is included in asset management, how to pick the right property management company, how often you should be talking to your property management company. And then we're going to be going over some top KPIs that you should be looking for when you are managing your assets, and how often you should be reviewing these numbers as well. And so I'm going to type into the chat box here so you can go into the website and register for the next webinar if you want to right now. As usual, we will also send out an email so that you can register for the next webinar that's coming up. And then, got Joey on here as well. Got his ticket to the Mfin Summit. Really enjoyed the January event. Thank you. Best information available so far. Charmalie is saying registering now. So thank you so much for your support and registering for it. I promise you won't regret it. And I'll also give you a 100% money back guarantee. So if you register for the event and you attend it and you for whatever reason, you decided it's just not the right thing for you, send us over an email. We'll give you 100% money back guarantee and 100% refund on that ticket. So thank you so much. Look forward to seeing you guys next week. And I hope you guys have a wonderful rest of your day. Bye-bye.